Hi guys, welcome to another video from Little Too Simple. It's not a secret that most of the general public doesn't like, or even hates, Wall Streeters. The Occupy Wall Street movement in 2008, followed by many other protests in the past decade, is evidence of this dislike and hatred. Most of this stems from the common belief or perception that Wall Streeters are greedy, exploitative, and evil people who will go to any extent to make money, even if it means throwing common people under the bus. Situations like the 2008 mortgage crisis are prime examples. Now, we do agree that people are not always wrong in considering Wall Streeters the bad guys. But as with everything else in the world, there are exceptions. And this video is about one such Wall Streeter who worked to do social good by financially empowering the common man. If you find these kinds of videos interesting, please explore our channel for more content on personal finance, financial success stories, and business case studies. Now let's roll. This video is about none other than the founder of Vanguard, John Bogle. But we're not making this video just because he founded Vanguard. We're making it because he introduced the concept of index fund investing. Today, the most common investing advice that almost all retail investors get is to invest in an index fund. They're recommended mainly due to their low entry, exit, and management costs, as well as their almost guaranteed long-term returns. Even the most successful investors, like Warren Buffett, are huge fans of index funds and recommend them often to everyone. With so much hype and so many recommendations around index funds, it's hard to believe that this concept did not even exist before 1974, when John Bogle introduced it through Vanguard. So, without a doubt, John Bogle revolutionized stock market investing. And since a lot of the money invested in Vanguard's index funds comes from retail investors like you and me, it's fair to say that John Bogle was a Wall Streeter who worked for the social good by financially empowering the common man. This is further reinforced by the fact that Bogle passed on most of Vanguard's profits to its investors, bringing fees down to minimal levels. This helped investors earn superior returns. That's also why a man like him, who was at the helm of one of the world's largest fund houses with trillions of dollars under management, died in 2019 with a modest net worth of about $80 to $100 million. Before Bogle launched index funds, mutual funds in general charged high fees and rarely outperformed the broader stock market. Since fund managers deducted their fees from the fund's profits, a large chunk of profits never reached the investors. But it's not correct to blindly blame all fund managers for high fees. Mutual funds had high operating costs, making it impossible for them to charge less. Having worked on Wall Street for over 2 decades before starting Vanguard, John Bogle was fully aware of the problems mutual funds faced and why it was so difficult for them to overcome those problems. What made him different was that while most fund managers just followed the system, Bogle wanted to reinvent the system, to solve the problems of high fees and low returns while reducing the risks for investors. John Bogle always believed that successful investing didn't require sophistication or complexity. Instead, all that was necessary was a healthy dose of common sense. This is evident from one of his quotes. "My ideas are very simple. In investing, you get what you don't pay for." Bogle solved 2 of the biggest problems of mutual funds, low returns and high fees, through simple common sense. Once he understood that beating the broader market was extremely difficult, if not impossible, he decided it was better to invest in the broader market directly. This ensured returns directly correlated to the market itself. Since investing in broader markets required minimal analysis and management, operating costs came down significantly. This allowed him to offer Vanguard services to investors at very low fees compared to other funds. Naturally, retail investors flocked to Vanguard's index funds, especially the Vanguard S&P 500 Index Fund, which tracks the top 500 publicly traded U.S. companies. And the proof is in the pudding. Vanguard grew its assets from $1.8 billion in 1974 to over $8.1 trillion in 2022, making it one of the greatest success stories in the mutual fund industry. However, not everyone is comfortable with Vanguard's massive size. Many in the mutual fund industry have expressed concerns that Vanguard is becoming too powerful. These concerns are valid, as Vanguard technically can move markets with $8.1 trillion worth of stocks under management as of 2022. Also, since index fund investing happens passively, without active trading, stocks often stay in Vanguard's holdings for very long periods. This raises concerns that if index funds grow too large, they might reduce liquidity in broader markets by lowering trading volumes. Despite these concerns, Vanguard has been one of the biggest beneficiaries of the retail investing boom that started in 2020. Between 2019 and 2022 alone, its assets under management grew by more than $3 trillion. This, combined with increasing interest in index funds from institutional investors, and the fact that almost anyone with even a little investing knowledge now recommends them, means the future looks bright for index funds in general and Vanguard in particular. At a time when most investing strategies lose relevance within a decade due to rapidly changing market conditions, John Bogle's strategy has been outperforming actively managed funds even 50 years after its inception, and it is expected to continue doing so for decades to come. This story shows what a genius John Bogle was. It proves that it's possible to make a lot of money while working for the social good by financially empowering the common man. It also stands as a reminder that not all Wall Streeters are necessarily bad. Thanks for watching, and see you all again in the next video.